Good evening, everybody. Sorry, we're getting a little bit started late. Same problems we normally have with Omnovia. But we are honored to have Wendy Kirkland here with us tonight. Wendy has been doing a lot of financial training for women, and especially in the options area. So without me holding up her time anymore, I'm going to introduce Wendy. And Wendy, we're very anxious to see some of your techniques.
Hi. I appreciate you being patient with us tonight as we work through a few little snags. For those of you who don't know me, I'm Wendy Kirkland. I have been a full-time trader for 9 years. I administer 4 advisories, and I've written a number of books that hopefully help share some of the things that I have discovered in those years. I've developed a few unusual trading patterns with you tonight. The list here is some of the books that I have written. Each one covers different types of strategies. Some are long, some are short. Several of them cover and incorporate the strategy that I'm going to discuss in the pattern that I'm going to discuss with you tonight. As it works out that we all kind of come to the stock market and option trading by different paths, that some people have a family involvement, maybe that you have an uncle or a father or somebody that was involved in the stock market and they have introduced you. Others come by way of education or are professionally involved, and then there's others of us that have come to it through financial needs, and that was how I became involved in option trading in the stock market. That a little bit of my history, back in 2004, my husband and I had been operating a retail gift shop for almost 20 years, and that had been our life's work, our goal, everything, our weekly paycheck and our retirement and everything was tied up in this gift shop. And in 2004, Hurricane Francis, at that point it was would have been Tropical Storm Francis, came through, and when we went to work the next morning, we had 5 foot of water in our retail gift shop. And everything was ruined, that there was mud and sludge and oil and sewage. It was just a mess, and we were devastated. Everything that we had is put in of 20 years' work was involved in the shop, and it just was a disaster. And during that time, a friend of mine took me out to lunch to help me feel better, and she mentioned option trading. And it sounded like a way that we could maybe help recoup some of the losses during the time that the store was going to be closed and during the cleanup. And we had no insurance. And to make this matters worse, as we were trying to clean up, Hurricane Ivan came through 2 weeks later, and so where we had taken walls down and were hosing things down, it happened all over again. So the 100-year storm happened twice in 2 weeks, and so you have to figure we were good for 200 years. That it was probably the hardest thing I've ever gone through, and it was so hard to overcome. We just didn't know what we were going to do. So my friend, as I mentioned, spoke to me about option trading. It sounded like something that might help us out. And during this situation, I took a few classes, and it was a great fit for me. We then worked on the shop, but on the sidelines, I read and did everything I possibly could in order to learn more and more about option trading in the stock market. And eventually I got to the point where I was winning more trades than I was losing, and I stepped away from the shop and started trading full time. Eventually, I was able to not only help through my trading for the shop to recover, but we were able to then really start building a retirement account. And I had achieved my own financial independence that went well beyond what we were able to do in the shop. And then that desire grew to help sharing and helping others achieve the same objectives. So I started writing strategy books, cutting away the things that seemed unnecessary in a lot of books that I had read, and narrowed it down to the little nuggets that would actually help traders achieve success. So we have books, we have newsletters, I do coaching, and then there's advisory services. Now, an odd thing that happened in this whole process was the fact that because of my art background, that my husband and I carved decoy ducks and birds. That was what the shop was all about, was a way to sell our artwork. This art training that I had really helped me in my option trading, in the same way that you all focus on candlestick patterns and so on. There was other patterns that jumped out at me that really helped my success to deepen in trading options and in chart reading. And this is what I want to share with you tonight as we go along. I have to go through the disclaimer. I'm sure every time that you have a presenter, they do the same thing. I want you to note that stock and option trading has large potential rewards, but also large potential risks. You must be aware of the risks and willing to accept them in order to invest in the market. This is neither a solicitation nor an offer to buy or sell any stock. We are just doing this for educational purposes. Now, I'm going to ask a question and say, so in a total number of trades, 129, how did I win 119 of those and have a winning rate of 92.25%? And the answer to that is there are elements that I have incorporated. One is the leverage of options. And we're going to look at an example of this in a Q trade in just a moment. But a second element is buying weekly option expirations, and we're going to go through the benefits of buying weekly options. And we also zero in on trades that have the squeeze pattern. And I'm going to cover some of the details of this and show you this pattern so that you'll be able to incorporate it in your own trading. So for people that are not familiar with options, and probably most of you are, but there'll be some that are not, there are two types of options. One is a call option, and this is when you expect the market to go up. And then there's put options, and this is when you expect that there's going to be a drop in the price of the equity. So the call options give the buyer the right to require the grantor to sell the equity to them at an agreed price on exercise at the agreed upon time. So that if you agree that the buyer is going to sell you an equity at $100, say as an example, if that equity then goes up to $120, you will be able to, within the same transaction, be able to buy it for $100, sell it for $120, and have made the $20 difference. On a put option, the buyer has the right to require the grantor to buy the equity from them at an agreed upon price on exercise at the agreed upon time, so that it's almost like an insurance policy that the grantor is going to buy the option from you for $100. If the price of the equity has dropped down to $80, you are going to be able to buy the equity at $80 and sell it then to the grantor for $100, and you will have made the $20 difference. And these options can be purchased for a fraction of what the price of the stock is itself. It's almost like a down payment on a house, that you are controlling the equity for a fraction of what the price of the property is itself. Now, options hold the key that I see to financial independence, and that is because they have leverage. And an example of this, we're going to lay out the details here, would be in a Qs trade. One of my new and favorite strategies is focused on just trading the Qs. You don't have to find just the right stock that is ready to move. You can focus and become an expert on just one equity, and that has great potential in itself, and we're going to use that as an example going through. But the details in this to point out the leverage. In a particular trade on the Qs, which is an equity that most of us are familiar with that is based on the NASDAQ, we'll look at a chart in just a moment, but say on June 26th, the Qs price is $71, and on July 15th, it has risen to $75.50, which is a $4.50 gain or 6.3%. On June 26th, the July 71 strike call option premium is 84 cents per share, or $84 per contract. On July 15th, then, the premium when we want to sell it is $4.38 per share, or $438 per contract. This is a gain of $354, or 421% gain in 13 days. So we're comparing here now a 6.3 gain in the stock, or a 421% gain in the options. That's huge. That is what brings about financial independence and can change people's lives. If you want to look at this another way, an option controls 100 shares of stock. So that if you were to take $71 times 100 shares of stock, you would have a total investment of $7,100. And it profited $450, which again was the 6.3%. Or you have the $84 for one option contract on those same 100 shares. It earned $354. So you have $4.50 and I'm sorry, I'm saying this wrong. $450 or $354 is quite close. We're only talking about $100 difference, and yet the investment difference is huge. That you had $7,100 versus $84. So for the same $7,100 investment, total investment, you could have bought 85 option contracts and earned $29,736 in just those 13 days. I mean, that is a huge difference. This is the chart for the profits that we were just talking about, for the trade we were just talking about. And so I ask, what if you had the key to seeing explosive moves like the one that you see on this chart before they happen? And if you had that key, what would be the best trading vehicle? So here we had the entry on June 26th, and we had our exit on the 16th. And what I'm going to show you ultimately in the pattern that I'm talking about would have showed exactly this being the time to get in and this being the time to exit. And so if you had this key to be able to determine that it wasn't up here that you needed to get in, it wasn't anywhere along this drop, that this was the exact area for the greatest return, and this then was the exit, you would have one of the elements to be able to change your trading to be successful most of the time. And we're going to move on now, and we'll build upon this principle by deciding what is the best trading vehicle to take advantage of moves like this and add additional leverage. So earlier we mentioned that we had options as one of the elements. Weekly options was the second element, and then we're going to go on to the pattern. So why weekly options? Weeklies are celebrating their third birthday, but are still new enough that many traders don't really get the advantages. And this is an area I'd like to focus on for a few minutes, and then we'll look at a few examples of the squeeze pattern. As traders, we've been taught that not only the value of time, but also to make sure we purchase extra time so that our trades have time to unfold and play out. This isn't the thinking behind trading weeklies. With weeklies, the aspect of time works in reverse. We're not looking for extra time to allow our trades to play out, but are providing we have the trade direction right, we're seeking protection against the market's fickle change of direction. We're using the short expiration time to our advantage. And we'll look at some of these particular advantages. One, it's cost effective. A fraction of the cost of monthly options. There's exceptional flexibility. It's a useful trade vehicle for a number of strategies, calls and puts, we talked about those, spreads, covered trades. Long-term trades are subject to market changes. With short-term trades, you trade what the market hands out to you for whatever period you're trading, whether it's hands out for the day, for the hour, and so on. Since weeklies are new every week, a trader can pick and choose to enter a trade at the moment that the action is happening. There's no need to tie up capital waiting for equity that is going through a pullback or a consolidation period. You enjoy 52 expiration periods a year. Weeklies are available on indexes, stocks, and ETFs. The exchanges offer new weeklies on companies that will attract attention each week. They change, they drop the ones that traders are not interested in, and they add new ones every week. And the new ones are usually ones that have high volume. 1 week a month, all optionable equities become weeklies. Weeklies are a short-term chartist dream because the question that you're asking is, where will this equity be in a week or less? You don't have to figure out where it's going to be in 6 months' time. The shorter time frame allows for more accuracy. Weeklies can be used in conjunction with news announcements, earnings report, FOMC minutes, even like the last couple days with the news events of Syria, that you can play those types of events up and down. Weeklies remain more reasonably priced even during periods of high volatility. Once the news is released, weeklies suffer less of a volatility crush than monthly options. Greeks, the weeklies are inherently offer a greater delta than the monthlies. Weeklies don't suffer from high theta. Time value is less of an issue. Cheaper prices mean you can purchase more contracts for the total investment, and therefore you're spreading out your trading costs over more contracts. There's an additional Greek benefit in that gamma is explosive with so little time value. Quick price moves before the market can change directions compounds the benefits and the leverage of option trading. And just more recently, the exchanges have received permission to offer weeklies for 5 consecutive weeks out in time. But at the same time, you don't want to buy too far out, or you will end up reducing some of the benefits, because you might just as well buy a monthly option if you're going too far out. Now, incorporating the strategies and the elements that I've covered so far, that again, I mentioned that my goal is to help other people. I'm just the everyday common trader who has achieved a level of success, and at that point now I am ready to share with others. I accomplish this by teaching options in general and the use of weekly options and the pattern that I'm going to show you in a few minutes, and incorporating that in specific strategies. The Q strategy book, the Merit Program, is my latest, and as I mentioned just a few minutes ago, it focuses on just trading the Qs so that you become an expert on just one equity. It helps you to be able to really anticipate the moves and how it performs. And to this, you're applying a number of different patterns, one of which we're going to be covering here. I use this to double my money in 2 days or less, 41 times in the last 8 months trading weekly options. And in those trades I was in, most of them only 3 or 4 days. There were some losers, 10 to be exact, in that period of time. And yet when you win 92% of the time and you have stops in place, the winners outpace the losers. There isn't a day that goes by that I don't hear from a trader or two that are experiencing great success using this pattern that I'm going to be explaining in just a few minutes, and the strategies that I've outlined in my books. That you can have trades where you win 164% holding a position for just 3 days, or 352% holding for 5 trading days, another 65% in a same-day trade, and so on. And most of these are investing about $600 per trade, so that if you had a premium of, say, 60 cents, $60 would be your total per contract, and you could buy 10 contracts and have a total investment of $600. So I ask again, what if you had a pattern that helped zero in on a move? This is a Q chart again, but it is a different time period. It's a more recent, from this entry on the 25th to the 5th of August. That is a nice move of $2 and plus cents, or 2.5 in the 7 trading days that it covered. So we're talking about option leverage, but we're also talking about weekly option leverage. And something that I've discovered is the fact that it takes just a small move in the price of the equity to equate to a double in the weekly option premium. It takes somewhere between 2.5% to 4% equity move most of the time to be able to double the option premium in a weekly option. And this is true whether you're trading the Qs or other equities. So we'll get off the Qs for a second so that I can show you that the pattern that I'm going to show you now works on any type of equity, not just the Qs. This is a chart of Barrick Gold, and if you'll take just a minute, there'll be candle patterns that you will be recognizing in here, whether they're bullish patterns in the drop. But there's a period of consolidation here from the 30th. There is a consolidation period from the 31st on into August 2nd. We have a drop, and then we have another consolidation period. So what in this chart, if anything, would tell you that the stock is getting ready to move up? We have consolidation, a drop, consolidation, a drop, some more consolidation. So we'll add some indicators, and this is going to help us see the pattern that I'm referring to. At the bottom of the chart, I have placed the PPO indicator. And the PPO is quite like the MACD that a lot of us use, but I favor the PPO. And in this indicator, it moves and by crosses of the signal line, which is the red line or the black line. And there's not a great distinctive cross here, maybe a little bit right there, and then a cross back down again. But anyway, I've placed the chart, the indicator here, and we're going to add to this and create the pattern. I've added the ADX indicator, and the area that I want to point out and draw your attention to is what I call the squeeze. These lines have come in close together. They've squeezed together. And this is the signal and the pattern that your eye will begin to pick out, and that will show that there's going to be an explosive move to the upside. This is where I was saying that the artist in me at one point just all of a sudden spotted that often when there was an explosive move, this pattern had formed. There is a similar pattern that would also show when there's going to be an explosive drop to the downside. But today we're going to focus on the squeeze. And we'll go on from here to let me show you what happened. It's not just the squeeze and the lines coming together. That's what's going to draw your attention to it. It is when the lines spread apart that you have the squeeze right here where they came close, but is this pushing away from each other, the spreading apart of the lines. Now, the PPO and ADX, they have nothing to do with each other. They're totally different indicators, but this visual pattern that you can see here where the lines come in close and then push away from each other brings about this explosive move. And you can see it very clearly here in a series of positive candles. Now, the squeeze, and you'll be able to see it as we go along, goes through 7 particular stages. It either is going to go through those 7 stages and then unfold, or it will re-squeeze and then it will go through the 7 stages. So here's the full move on Barrick Gold. This was the squeeze that we saw on the earlier chart, and here the indicators have, you've gotten more space between the PPO line, and the ADX line is showing strength and momentum behind this upward move. And so we went from this area of consolidation and being at $15.75 all the way up to $19. That's a $4 move on an inexpensive stock. That's a huge move. And what an advantage to be able to see that this is actually going to take place, to be able to prepare for it and to get into a trade. And then once you know the 7 stages that the squeeze is going to go through, you know exactly when is the proper time to exit. So on the trade that we were just discussing, if you had purchased calls mid-trading day on August 8th for 47 cents per share or $47 per contract for the August 4th week 1750 strike call, let's say we bought 12 contracts for a total investment of $564, and we sell at the end of the day on August 15th. The contracts were worth $2.15 or $2,150 for the 10 contracts, which is a total gain of $1,586. That's 281% on that move that we saw for just those few days. Now, Barrick's price when we entered the trade was approximately $15.80, like we mentioned, and we sold it. It was $19.80. So that $4 change in price, was a hefty 25% increase in the stock's price over 6 days. But that is an option premium that increased 281%. And you were able to purchase 10 contracts for a fraction of the price of what the stock would have been. That's the leverage that you can get from weekly options. It compounds your return. So we'll go through these rather quickly. This is another squeeze pattern. You'll see that your eye will begin to be able to pick them out very quickly. And some of the squeezes, the lines can be very, very close together like this. They're almost touching. And other times it can be further apart. And that does not have anything to do with how explosive the move will be. Though this is wonderful. It almost is straight up in the air. It's as the lines push away from each other. Now, the time tonight is limited, and I wanted to be able to introduce you to this pattern and to be able to see how it works. But there are other indicators that are added to this that give you the go-ahead. That we'll see some other squeezes that did not work out quite as well as this, and it's because all of the elements were not in place. All the confirmations that you needed were not in place. But this pattern, anytime you see the lines come together, when you get the go-ahead signals, the confirmations, is going to explode and move up like this. It's a guaranteed pattern. So here we spot another squeeze. This is on Newmont Mining. Again, this was earlier this month. And you see the lines came in very close together. Then they pushed away from each other. And you had a nice $4.50 rise. This is a new squeeze pattern. And so this would be an alert to you that if you're looking through charts and you were to see this taking place and forming, this would be a stock that you would be looking for those confirmation signals so that you would know when exactly the right time to enter. Here's a place where the circled area to the left, this is also a squeeze, and the lines started to push away from each other, and it didn't fulfill, in a sense. It didn't have all the elements. It went up a little bit here. I guess it's almost $1, but then it faded, and it didn't quite really do it right here, but then it as it pushed away, again, it went up in price a little bit. These two areas, these squeezes and re-squeeze, did not go through all the stages that I mentioned. It was like they got started and they stalled and stopped, and this is then a re-squeeze, and we'll start looking for the elements and the confirmations on that to know that it can go ahead. Here's Home Depot. Again, I have no doubt that your eye is already trained to be able to see this. The lines pushed away from each other and spread. And over the next 4 or 5 days, you had this wonderful uptrend and climb up. On Home Depot's trade, the point I want to make here again is the small equity price move that's needed to be able to have the option premium multiply for there to be that extra leverage that I'm stressing. So if you'd purchased calls mid-trading day on June 24th for 75 cents a share or $75 per contract for the July 13.75 strike call, let's say you bought 8 contracts for a total investment of $600. We sell at the end of the day on June 28th, which is 4 days later. The call contracts were worth $3.50 or $2,800 for a gain of $2,200 or 367%. Again, that is where that leverage is. You can have huge gains in a short period of time when you get the direction right. And the squeeze pattern helps you to be able to zero in on those upward moves. Home Depot's price when we entered the trade was approximately $73, and we sold it was $77.50, so that was a $4.50 price change. And this is a 6% increase in the stock price over those 4 days, while the option increased, again, 367%. That's huge. The pattern appears on every type of stock or equity, every type of chart, so that when you couple this with the candlestick patterns that you all have learned to look for, this is a chart of the Dow, of the Indu. And so here you have a squeeze that has taken place. The lines have pushed away from each other. You would have had the confirmations that this was getting ready to happen. You wouldn't have done it here if you had been wondering at this point, the lines had come together into a squeeze. You would have been saying, well, maybe this is the place to get in, but it wasn't. There was another huge drop. So you want the confirmations that tell you that the timing is right for the squeeze to play out, and then you have this rise. When you see a chart like this, it is time to trade the plan. You couple this with what you know with candlesticks, with perhaps engulfing patterns and so on. You have a win-win strategy. You look for the confirmations and you have an even bigger winner. That you can see here that there is a squeeze that played out, and there's another squeeze that is forming. You've got the one here, it's coming very close. It's time to start looking for the confirmations as to whether it's time to enter. Here's an example of one that played out in the first week or into the second week of August, where the lines pushed away from each other, and you had a very nice climb from $80 up to $84.50, so a $4.50 move in just that short period of time. All squeezes are not the same, and that's what I was saying earlier about needing to be able to look for the confirmation signals, and the books that I've written go through all of the details. It covers everything, so that it's not holding back some little key. Everything is laid out in here. But here you have a series of squeezes that did not play out, and the confirmation signals would have kept you out of these trades. You had the lines push away, and yet you didn't have really the strength, the upward strength to push this any farther. It just consolidated and went flat. And then it dropped down a little bit, tested the support of the signal line, dropped a little bit, started again as these lines pushed away from each other, went up a smidge, and then it dropped right back down again as the lines, it had to rest a little longer, pushed away and went up, and now we've gone flat one more time. So you need the momentum and the confirmation signals to let you know that the squeeze is going to have the energy it needs to have that explosive move. Here's another one. This is BP, and you can see what a beautiful little squeeze this was right here. The lines pushed away from each other, and yet this just totally went flat, traded in this little narrow channel for the better part of August, half the month. And the lines here just did not have the kick, the momentum, the push, the energy to be able to go up and have this squeeze yet play out. You end up learning to pick the winning squeezes to know which ones are going to give you the potential to have the move carry the trade forward. Here you have two. This is a squeeze, even though it isn't as tight as some of the ones that we've seen earlier. And yet this still was a $2 move, which is approximately 4%. So even this little climb right here would have more than doubled, or right at a double, probably not 300%, but probably would have been right at 100% move. And this $4 move from this squeeze, here you go, it spread apart, pushed away, climbed up. You have this nice move here, which was a $4 move, or approximately 9%, and this probably was right at 300% profit. I think maybe we have the figures coming up next. Yes. So Joy's trade had you entered on August 8th, purchasing the August 13th 50 strike call with 8 days until expiration for an ask premium of 69 cents per share, or $69 per contract. Had you purchased 10 contracts for a total of $690, and you notice on all of these trades we've kept it around the $600 mark. And you sold the trade on August 13th for a bid premium of $2.58 per share, or $258 per contract. That's a total of $2,580 for the 10 contracts. That's a profit of $1.89 per share, or $1,890 for the 10 contracts. And that was a gain of 274% in those 4 days. So it wasn't quite 300. I'm sorry, I goofed. It was 274. That's not bad for 4 days in a trade. So the squeeze is part of this wealth building process. It's one of the keys. So we mentioned that we trade options. We trade weekly options or front month where we get that leverage. You follow the strategy guidelines as to open interest and volume, the spread between the bid and the asks, so that you're selecting the option with the greatest chance of producing leveraged results. You only trade stocks or ETFs that have large moves. It wouldn't make sense to trade a stock that has very little volume and very little open interest and have moves of 16 cents or whatever a day. That's not the types of moves that we're looking for. You then concentrate on long trades, incorporating the squeeze pattern. You use the confirming indicators, and you only enter when you have those confirmation indicators that signal it's a safe and profitable entry, or going to be. And you learn and understand the stages that every single squeeze must go through to complete the pattern. This knowledge then will tell you the entry, the possibility of a second entry, where you can add to a position, or if you missed the first entry, you can enter on that signal. It tells you when to hold, it tells you stop losses, and it tells you profit exits. Now there are several books or several programs to fit different traders' pattern trading styles. That the Price Surge System book trades weekly and front month options, calls and puts, and it uses intraday charts using the P3 squeeze pattern that we kind of discussed tonight. And there's a cousin pattern called the P3.5 short pattern, and it shows exactly when a drop is going to happen and the precise entry and exits for that pattern. There's a book, there's a newsletter, and there's an advisory. The newsletters come out on a weekly basis, and they give candidates that are creating these patterns. So the book teaches you how to, use the old analogy, how to fish, and the newsletters give you the bait. And then for people that don't have the time to be watching charts and trading themselves, there's advisories. The weekly Wealth Building with Weeklies, it trades weekly options. It's a very simple chart setup for people that get bogged down with too many indicators. This is a very simple setup. It trades calls and puts. It's a book, a newsletter, and an advisory. The P3 is a longer swing strategy. It uses the squeeze on daily charts. And so you're in a trade for a number of weeks at a time, sometimes a couple months at a time. It's a book, a newsletter, and an advisory. The Merit Q program is brand spanking new, and this is one that I'm really excited about. It's the one that I mentioned earlier, where you trade and focus on just one equity. And that might seem like an odd thing, but it really helps you to get to know and anticipate the patterns and how the equity performs during all the variety of situations that come up. You're using and applying very clear trade patterns such as the squeeze or the P3.5 and a couple others that are outlined in the book, and it too is an advisory. To explain a little further why or what the advantages might be to trading just one equity and becoming an expert. These are some of the reasons. The Qs have extreme liquidity. You have guaranteed quick entry and exit. There is never a problem with getting filled. It happens in the snap of a finger. There is high daily volume. You get automatic diversification. The Qs is a basket of 100 different companies within that, so that you are getting a full range of tech stocks, of some medical, bio. It just is all within the Qs, and it spreads your money out through a variety of sectors. All brokers accept Q trades. It's a lower risk equity. It has super small bid and ask spread, sometimes just a penny or two. The premiums are very low price. You can often get 10 contracts priced around $600. It trades all types of options, weeklies, monthlies, leaps. You can read the Qs chart just like you read any other chart, and you become an expert reader on just the one equity. You can short the Qs by buying puts. It has the same brokerage requirements. There's no minimum purchase requirement. It settles in 1 day after a closed trade in a cash account. It has low volatility, and yet being involved in the Qs trade as an equity, it helps you to profit from market volatility. There's a strike at every dollar and sometimes every 50 cents. The trade day closes 15 minutes later than the rest of the market on the Qs. I have traded the Qs after earnings reports from tech stocks and so on, and closed a trade and been able to profit after an aftermarket release of earnings. And this ends the search for the stock that is ready to explode out of thousands, that you can find squeeze patterns, P3.5 patterns, spins, and all the other ones that are incorporated in the book within one equity. So you just change from maybe a 60-minute chart to a 15-minute chart and are able to go up and down the various time frames and be able to find one of these patterns to be able to always be able to find a trade on that one equity. If you think about this, it becomes a quadruple win trading program. You have the leverage of options, you have the leverage of weekly options, you have the squeeze pattern, and then you are able to apply this to just one equity. The Qs are the most liquid of all the equities in the stock exchanges. And then you have the merit program that trades the Qs in various time frames using clear trade patterns, including the squeeze. You couple those and you end up with something that is affordable, a trading program that's affordable for the everyday trader, just like me. If you're interested in more information, there's a contact number here, an 800 number, 888-233-1431. A separate number if you're interested in auto trading the advisory. Email support is support@iss-trading.com. I have a general website that includes all of my books, including the Quintessential Qs, the Merit Program, and you can view that at wendykirkland.net. And for being here tonight, you all will receive a special bonus report for attending. And if you copy down this link, there is a special offering of the CUES program for tonight's attendees. Steve, are you there?
I am here, yes.
Okay, good.
Let's see. Let me see. Are we trying to get the link? Let me see if I've got it over.
Yeah, if you can post that into the chat area, they'll be able to click on it, I think, to get up more information. Otherwise, they will need to, I don't know if they can copy and paste this or if they will just need to write it down.
Let me see if I can. I've got it here. Is that it? Okay, thank you, everybody. That's faster than I could have done. Yeah, there they are posted. So just click on those, and there will be some special prices for everybody. Can you see questions?
I can't. I can't. I still actually have my PowerPoint up in front of me here.
Okay. Let me go through a couple just to see. Somebody was asking PPO. How PPO not on Thinkorswim have to use? Is that what it is? Is MACD?
Yeah, you would have to use the MACD on the Thinkorswim program or charting site. The MACD and the PPO, there is very, very little difference between the two. I prefer the PPO, but the main difference that you see is in longer time frame charts, and so the MACD works just as well.
Okay, is there any specific numbers on the MACD?
You can just use the default.
The default, okay.
Yeah.
All right. Let's see. If anybody's got questions, go ahead and ask them, and I will just repeat them back to Wendy so she can answer them. Oh, let's see. The phone number. There's the phone number, Oscar. Is there a special trial time frame offer? That's a question we're getting, Wendy.
The link that they'll follow for the CUE program will go through all of the details that they put together a special program just for the attendees tonight, and I'm not sure of the particulars on that, but it covers they're receiving a book and participating in the CUE program where trades are given to the subscribers and so on.
Okay.
And the book is a 206-page book. It covers all of the details with charts very clearly giving exact the specific confirmation entry and exit signals. There isn't anything that's left out. A person can review that and read through it and be able to trade the patterns perfectly.
Okay. Let's see. Alan is asking, I noticed the ADX values were different on different stocks. Is there any reason for that?
It's because it's geared toward the particular the stock itself. It's based on the movement of the stock. That the ADX line is done on a percentage between the directional lines, the DI lines, and that varies for each stock.
Okay, nice.
As I was going to insert again and just kind of stress that the pattern, it just is one of those things that worked out. One day I was looking at a bunch of charts, and I was looking at all the trades that I had done really well on. It was like during a monthly review of my trades. And I always attach a copy of the charts to a sheet of paper, a trade form that I use. And I started looking at the charts and saying, well, why did this trade work and this one didn't? And I spread these papers all over a desk and was trying to get a big overview of the charts and of the trades that had worked really well. And all of a sudden, it was like it slapped me in the head, really. And I saw this pattern, and it was like, oh, my gosh. And from that point on, then, I really started studying it. And I actually wrote one book before I realized about the 7 stages that they go through. So it's been doing and gathering the information from the newsletter and looking at so many charts, thousands of charts, that these extra pieces started fitting in together. And then at some point along the line, I not only had the pattern for the long trades, but I realized there was a pattern for going short as well, and it goes through the same 7 stages. And so it was this perfect trading. You can get in as it's going up, and you can get in as it's going down, and it tells you exactly what your entries and exits should be.
All right, great. Let's see. Is there a price just for the book?
At this point, I don't believe that there is. Okay. It's kind of a package deal.
All right. Is the MACD SMA or EMA? I don't know whether that's a simple moving average, Roy, or whether there's one in there.
Yeah, the book covers some EMAs that are used, but the MACD is, I forget if it's 12, 26, 14 or something like that is the default. I'm sorry, I don't have a chart in front of me to say what it is.
Okay. All right, well, that was very good information. Once again, Wendy's not here because she's developed a trading program and liked everybody to use it. She's here because she had to develop the trading program for herself and make it very successful, and now showing other people how to use it. Whoops, I'm really soft and she's really loud. Okay, hopefully that will work out a little bit better. But anyways, this was excellent information. Anytime you can start putting other little tweaks into your trading program, that just gives you one more advantage of why a trade's going to work in your favor, and not only work in your favor, but have an explosive move. I mean, that's basically what we're looking for. If we could narrow down all our parameters to find that great trade. Oh, one question, Wendy. Somebody was asking, how often do these trades become available? Are they something you find once a day, once a week, once a month? What's the frequency of these trade setups?
Regularly, numerous ones throughout the day, depending on the chart frame that you find them on. Depends on how long they last. That as far as finding trades on the queues, you can always find something to trade on one of the various time frames. If you're looking outside of the queues, they again happen regularly. The newsletters that come with the books usually list maybe a dozen stocks or equities that are creating this pattern. So you always have plenty to choose from, and it could be that you decide that on a particular week that you think that oil stocks are going to move, and you see one of these setting up to have this explosive pattern, and so that's where you focus your attention. But there's not a scarcity of stocks creating this pattern, and there's not a scarcity even when you trade just one equity like the Qs.
All right. All right, well, very good. Well, Wendy, this was great information. Thank you very much.
You're welcome. I appreciate so much you inviting me to share this with your people.
Well, great. Everybody, thank you for coming tonight. Wendy, thank you for the presentation. Once again, anytime you can start adding little bits of information that will improve your probabilities of being in the correct trade at the correct time, and especially if you've got indicators like Wendy has developed to show you when one is setting up, then you can be prepared for it and ready to take advantage of it. And that's the basis of good investing, is not reacting, but being proactive on your trades. With that, Wendy, thank you very much, and thank you, everybody. We'll see you in the chat rooms.
Good night.